Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Anthony Golowenko from MLC Asset Management. We are going to be speaking about MLC's Managed Account Strategies, which is celebrating its 5-year milestone. We will be reflecting on the journey so far and the opportunities that lie ahead. Welcome, Anthony.
Great, thanks for having me.
So, Anthony, it's been a fascinating few years in markets. We've had COVID, we've had inflation shocks, rising and now potentially falling rates. So from your perspective, how has this backdrop shaped the way investors are thinking about their portfolio today?
Sure, like if we go back 5 years, and look, it is nice to be sitting within 1.5 metres of you today. So go back 5 years, and it was really about bond yields and longer term yields domestically and globally being at incredibly low levels, as was a cash rate. So the key challenge for investing, how do I earn a meaningful return? So a key positioning at that time for us was really in that fixed income sleeve. We had substantial weighting in our short maturity credit exposure and very little, pretty much the lowest we could have in all maturity securities. So that played out. We've adjusted our portfolios accordingly, and now we're in a position that, again, rates seem to be dominant, and we've seen, as with the time of filming, we've seen the US rate cut come through. So all of which for us in that journey in over 5 years, with twists and turns and everything in between, the strength of equities and global equities has been a real feature. I'll talk to some of our positioning around that, but for us, really about delivering consistently for our clients, delivering diversity and resilience in outcomes, and doing so consistently, really regardless of market environment or twists and turns along the way.
Yeah, sure. So there's been a lot of debate about inflation. How are you viewing the balance between inflation growth and policy response? And what does that mean for investors thinking about the next 12 months?
Yeah, sure. So inflation, and we think initially through COVID and out the other side of COVID, you had a real surge in goods inflation with wages growth that sort of caught up with services. Now we're seeing, I think, call time on goods, and that is starting to certainly ease back. With services inflation and that wages piece, it's more of a glide path lower. I think we have reached, and touch wood, we have reached that softer landing. A feature though for central banks is really now around the employment market. Now that came out overnight rate cuts, and overnight the Fed talked about employment market and some concerns in the robustness. Domestically, we've had a care economy, a government focusing with that childcare, aged care, disability care, broader management or administration and infrastructure. Now that's come back to more sustainable levels with the backdrop of economic growth a bit more subdued. Where and how do we get that spark of employment growth and falling to the private sector? That's really a key challenge. So we see inflation much more under control, rates coming off, fiscal accommodative policy in the US and in Europe, and all of which paints essentially a much stronger backdrop and firmer footing for global equities.
Anthony, you mentioned in the recent quarterly update that currency has played a bigger role than usual. How are you thinking about the Australian dollar in portfolios today?
So for the global sleeve of our equity program, we're running developed markets at 55% hedged. Now, to contextualise that on a long-term basis, we're more like 35% hedged. So we obviously view the value of foreign currency and diversity attributes it provides as being a bit less. The Aussie dollar, we see potential in it being undervalued. The flip side of that really comes back to the US dollar, and we've seen that sort of weaken, continue to weaken, and overnight we've seen rate cuts, and that framework has an initial impact and direct impact on US securities, but is more favourable to positioning such as emerging markets. We've seen really strong results and encouraging results in the likes of China, but also in the broader emerging markets complex. So we are positioned in that way from a hedge perspective, with a meaningful exposure to emerging markets, and all of which is in our purposeful portfolios by design to achieve consistent outcomes for our clients.
So this year marks the 5-year birthday of the MLC Managed Account Strategies. Congratulations.
Go us.
For those unfamiliar with the approach, can you explain what managed accounts are and why the appeal for managed accounts has grown so much in recent years?
Great question. To distill it down is as simple as a platform technology solution. So as that technology is evolved, we've a democratized solution, highly efficient, transparent. I guess the onus is on us to provide real clarity in our positioning, how we describe the outcomes delivered, and ultimately it's about that leveling up in advice experience for clients and delivering improved outcomes in a way that, say we put through a portfolio rebalance in August. The historical model would be going through, meeting with clients, individually changing all of those asset allocation weightings as appropriate. Under a platform technology solution, the turn, if we think about a big sausage machine, we turn the handle and that change goes out instantaneously across all models and across all individual investors. And that technology solution with an organisation such as ourselves, an institutional asset manager, is really, really powerful. And as I said, really levels up this proposition and solution, and hence there's been that incredibly strong growth.
You have a deep research network at MLC that spans 40 odd years. Take me through some of the key themes and opportunities that the team is identifying at the moment, both on the defensive and the growth side.
Great. So, well, 40, perhaps it is the new 30, or in my case, 50 is the new 40, but we will continue on.
Let's stop exposing ourselves.
We are fresh. We are 5 years in, and for a 40-year journey, it's all part of an integrated team, some humility, a sense of humour, working together collaboratively for our clients. So what does that mean, and how are we positioned in our framework? Our positioning at this point in time on an equity standpoint, we've some concerns around perhaps meagre earnings growth in Aussie equity, particularly large caps. So for those viewers who may be thinking about their positioning into domestically potential smaller opportunities in that environment of rate cuts and monetary stimulus, or looking more globally for growth, we see the footing for global shares as being more appealing. And look, if I'm honest, we go back 2 years, we saw the narrowness of global shares. We saw that around really the magnificent theme. Positioning portfolios from an asset allocation standpoint, we took some exposure, put that into alternatives, into global credit and emerging markets. Now those delivered fine returns. They were in the order of probably 10 to up to maybe 14%, but it wasn't the 20% plus of global shares. So that's on me. Bonehead decision to allocate away. But that's a learning experience. There's the risk and the return component. On the more defensive side, global credit is one that I mentioned, but probably the biggest, and which we're rolling out of actually at this point into real assets. But the biggest one was in that period from COVID. We had ultra low cash rates, ultra low yields, were exposed in a way, and as that normalised with rapid rate increases to tame inflation, that benefited the portfolios considerably from an asset allocation standpoint. So there's sort of two, and a fess up as to something that could have been done better in hindsight. But as I said, we want to be consistent and we want to be humble in our opinions and what we actually deliver.
Anthony, how does the team analyse risk and what scenarios are you monitoring closely right now?
Fantastic. So at the time of filming, we're probably 2-3 weeks away from both NRL and AFL finals. And I don't know if you can capture that, but I actually got a Canberra Raiders pin. But what's all that relevant for investing from a risk standpoint, or the simple question, what do you know for sure? Okay, I believe Canberra Raiders will win the premiership. Now that's an opinion, that's emotional, but what do you actually know? And even looking out 2 to 3 weeks, there's incredible uncertainty in that end result and end outcome. From an investment standpoint, let's look out 2 to 3 years. And that underpinning, a humility, a recognition of, here's our central case, what are the contours around that case for both upside and downside? So to the upside scenarios, obviously technology is probably an AI, the biggest theme globally. We see productivity gains, we see improvement and potentially, further expansion in margins. Obviously, that's pretty comes through. The other side, if you are to see a bit more confidence, is more a credit creation, banks lending, businesses investing, and we see further upside from here under that scenario. Probably a more logical one, and the tariff trade reset the Trump administration is working through at this point in time, is on protectionism. So protectionism is a scenario we see that margins will be pressured a bit more, a bit higher inflation, and we don't see that being more positive, we see it being more negative on the growth side. And in an Australian setting, Australia-only weakness. I've mentioned large caps we see as being quite fully valued for meagre earnings growth. As a growth asset class allocation, it's one where we're thinking there's other opportunities. So Australia-only weakness is that second of the downside or slower growth scenarios from here, all of which predicated on fairly full valuations as we see them.
The model portfolios are constantly evolving. Can you take us through some of the most recent changes and what that says about your outlook on the market over the next 2 to 3 years?
Great.
If you can look in the crystal ball.
Yeah, sure, easy. If I think of what we've done and some of the positioning over recent months, so in May and in August, we took what was a slightly more diverse or a slightly more defensive positioning across our portfolios, and we've added exposure into global shares. I've mentioned the monetary side of things, the fiscal side, and just a firmer footing. We've seen Europe start to move, Japan, we see emerging markets as appealing. So that firmer footing has seen us allocate away from Australian equity large cap into global shares. And the other point with that more optimistic view is a tightening in credit spreads. So for investment grade credit, for sub-investment grade credit, those tightening up, and we just see in both real estate and listed infrastructure, we see a strong opportunity where there's underlying cash flows which are supported and can grow over time, reasonable valuations, and coming together in something that beyond the actual return of capital and some sort of yield, we're getting growth over time. So we like that asset class. And those are the positions we've put through. As it stands, we're sort of neutral to boilerplate naming conventions across our portfolio suite. We are leaning a bit more risk on in the likes of emerging markets. We maintain some global credit. And as I said, we're sort of thinking into more smaller companies in Australia and globally.
Anthony, each of your portfolios gets exposure to markets through direct holdings and through funds. So why is that the optimal mix for portfolio construction?
Look, for us in our program, probably starting point is what our clients have expressed and advisors have expressed that their preference is. Look, most of us have some familiarity with Australian shares. The structure and transparency and beneficial ownership mean that franking credits or dividends and franking credits flow through directly to the end client. So that's a positive feature. So really from a product design, having transparency, efficiency, and that flowing through with, I guess, familiarity and, for many Livewire viewers out there, their own instances of Australian shares and holding them. If we move them beyond into to smaller companies, and for our program we might have 20 to 25 direct shares, smaller company fund might own 50 names. So in a transparent, efficient solution, we don't want this to be some unwieldy 100, 200 line items in a portfolio. So the way we've addressed it is funds where such as smaller companies, into things like syndicated loans. There's a very large number for diversity, for resilience in our program that we're utilising funds for. The example from Australian shares, more conservative portfolios, the entire exposure is direct shares, much more income orientated with franking credits. As we move out to growth orientation, where we're bringing in small caps, selective mid caps, global and EM, and that global and EM component is demonstrably higher versus the direct piece, and it's about that blend together. If I talk a little about funds, and we may have a question about how we select them, but for funds and our experience over 5 years, sort of moving through as we grow from various rebate tiers, we might then move into institutional class funds, and we've been privileged to work with select partners and actually build a private menu, so not available for everyone, a private menu solution, in this case a hedge version without performance fees at a lower base fee. A win-win-win, and the transparency, the efficiency, what can be contained in our program, readily accessible. But to go and build that yourself, I can't exactly say what it would be with 100% confidence, but I'm reasonably sure it would be in the order of 50 to 60% or 40 to 50% cheaper to come and look with an established provider such as ourselves. And that's part of the appeal of the program, and that's part of that size, scale, and leveraging that to grow together with partners that we offer at MLC Asset Management.
So can you walk me through the process for selecting the fund managers that you work with?
Yeah, fundamentally, it's not that dissimilar to individual stocks. You want to think about quality. So what it may mean, have you done this before? Your tenor of team, the culture of that team, how they work together. And I work collaboratively with at MLC in Australian shares, global shares, fixed income credit. We have an alternatives team, derivatives team. So I'll work collaboratively with that team who are themselves experts, experienced, just looking at a single asset class, to really refine what we need in our model portfolio program, the sorts of exposures or types of managers we are seeking, and then working through, as you may on a company, like management, how is it run? What's the philosophy? Have you done this before? What environment are you expected to perform in? And working collaboratively in that way, a big advantage for our sector portfolio managers is not having to do research on hundreds of companies. What's my really high conviction shortlist? Maybe I've got a handful of other managers who can step in there, but regular review. We have quarterly updates. If someone maybe like, I'm sure you're a very good student at school, but if you, other students who weren't so good, didn't do their homework, maybe it's at first, hey, you haven't done your homework. Second stage is, well, amber, maybe a letter goes home. Third stage, we have the same thing. I'm sorry, I don't want to, probably just 5 years ago, a handful of years ago, you're at school. So working through that, it's the same process. Moving to amber, there's a governance structure, an investment committee, a review, and over that 5 years, there have been changes, and often changes where manager may have not delivered as we expected them to deliver, or otherwise, a equivalent or high caliber, potentially higher caliber manager can be delivered and brought into the program at a more attractive fee level and hence of benefit to the program. So there's a couple of little insights, attempted humour of how we think about our program, but it's the institutional horsepower we bring. That's really a feature of what we do.
Okay, so finally, if we were to sit down 5 years from now, what do you think we'll be reflecting on, both in markets and in how MLC Managed Account Strategies has evolved?
I think if we're talking about 5 years into 10 years, 40 years being the new 30, 50 or 40, we'll be thinking, how good are we? How well have we aged? But seriously, it's ultimately about the investment journey, a consistent investment journey, a program we strive each day, me and the team, all of us strive to deliver for our clients and deliver on our promise. And as much as there are different superannuation, wholesale products, strategies, investments, all of it really comes down to a very honourable profession of helping underwrite people's life's work, secure your investment journey. And if we've done that, if we've applied our focus, our institutional resources, aligned in a way that we're transparent, honest with ourselves and humble, I really hope in 5 years, if it's me or someone else, we've delivered on that promise. We've delivered for our clients consistency, delivered diversity and resilience, and done so, I think, in a very honourable way and done it the right way.
Okay, great. Thanks, Anthony, for sitting down with Livewire today.
Thank you so much.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel. We release great new content every week.